Hello everyone, you are welcome to another video of this course. In this module, we'll be learning about development and production costs. And under that, we'll be looking at capital and revenue expenditure, depletion, and then we'll look at depletion methods. We would also look at depreciation, depletion, and amortization. These were mentioned a lot in previous videos. So it's important that we have an understanding of all of these concepts. So quickly, let's dive in. Development and production costs. What does that refer to in oil and gas? In oil and gas accounting, development and production costs refers to the expenses incurred after reserves are proved and before production begins, including costs for accessing, extracting, and treating oil and gas. These costs are categorized as intangible drilling and development cost and lease and wellness equipment cost. The intangible drilling and development cost typically includes downhole costs like drilling, well servicing, and preparation, while the lease and well equipment fund cost, also known as LWE, encompasses the equipment used for well operation. These costs are incurred to provide access to proved reserves and the facilities needed for extracting, treating, gathering, and storing oil and gas. They are distinct from exploration costs, which are incurred to find new reserves. So let's look at the IDC, the intangible drilling and development cost. These are expenses related to drilling and developing the well itself, including the well bore and its immediate surroundings. And examples include preparation for drilling, including site preparation and mobilization of equipment, drilling costs including labor, materials, and equipment for drilling the well, well servicing such as fracturing, acidizing, and other treatments to enhance well productivity, cost of subface well equipment, including the materials and labor to install the equipment. Now, what are the lease and well equipment costs? These are costs for the tangible equipment needed to extract and process oil and gas, such as surface well equipment, including pumps, separators, and other equipment located on the surface. Other well equipment such as casing, turbine, tubing, and other materials used to complete the well. Gathering pipelines and other infrastructure used to transport oil and gas from the well to processing facilities. Examples of development costs are drilling and equipping development wells, building production storage tanks, constructing gas processing plants, constructing and relocating roads and power lines. Now let us look at production costs. What are production costs? Production cost refers to all the direct and indirect costs businesses face from manufacturing a product or providing a service. Production costs can include a variety of expenses such as labor, raw material, consumable manufacturing supplies, and general overhead. Production costs are the direct and indirect costs associated with manufacturing a product or providing a capital expenditure, and revenue expenditure may refer to money spent by companies to keep their day-to-day operations going. But there are some differences between these two, including how they are used, whether it's to make purchases for the short term or the long term. So let's look at capital expenditure versus revenue expenditure. Capital expenditure and revenue expenditure refer to money spent by companies to keep their day-to-day operations going. But there are some differences between these two, including how they are used, whether that's to make purchases for the short or long term. Capital expenditures are funds used for one-time large purchases of fixed assets that will be used for revenue generation over a longer period. And this could be to acquire upgrade, and maintain physical assets such as property, buildings, or equipment. Revenue expenditures, on the other hand, are typically referred to as ongoing operating expenses, which are short-term expenses that are used in running the daily business operations. This type of spending is often used to buy fixed assets, which are physical assets such as equipment. As a result, capital expenditures are typically for large amounts than revenue expenditures. However, there are exceptions when large asset purchases are consumed in the short or the current accounting period. What are the types of capital expenditure? Capital expenditure can include the purchase of a facility or factory, including an upgrade or expansion. It could be vehicles such as trucks that are used for delivery of products. It can be manufacturing equipment. It could be computers. Just basically the things that are needed for production or need to be purchased for production. Now we have revenue expenditure. Revenue expenditures are short-term expenses used in the current period or typically within 1 year. Revenue expenditures include the expense required to meet the ongoing operational cost of running a business and thus are essentially the same as operating expenses. Revenue expenditure also include the ordinary repair and maintenance costs that are necessary to keep an asset in working order without substantially improving or extending the useful life of the asset. These expenses that are related to existing assets include repairs and regular maintenance, as well as repainting and renewal expenses. Revenue expenditures can be considered to be recurring expenses in contrast to the one-off nature of capital expenditure. And so types of revenue expenditure, they can include salaries and employer wages. They can be overhead expenses such as salaries for the corporate office, which typically falls under selling, general and administrative expenses. It could be for research and development. It could be for utilities and rent. It could be for business travel, for property taxes. Now let's move on to depletion. Depletion is an accrual accounting technique used to allocate the cost of extracting natural resources such as timber, minerals, and oil from the earth. Like depreciation and amortization, depletion is a non-cash expense that lowers the cost value of an asset incrementally through scheduled charges to income. Depletion for accounting and financial reporting purposes is meant to assist in accurately identifying the value of the asset on the balance sheet and recording expenses in the appropriate time period on the income statement. When the costs associated with natural resource extractions have been capitalized, the expenses are systematically allocated across different time periods based upon the resources extracted. The costs are held on balance sheet until expense recognition occurs. There are primarily two depletion methods: the percentage depletion method and the cost depletion method, which you will learn more about in further modules. But let's quickly look at the depreciation, depletion, and amortization. Now, depreciation, depletion, and amortization are accounting methods that systematically expense the cost of assets over time, with depreciation applying to tangible assets, depletion to natural resources, and amortization to intangible assets. Depreciation, depletion, and amortization is an accounting technique that enables companies to gradually expense various different resources of economic value over time in order to match cost to revenue. It is common in almost every industry. While depletion is usually used only by energy and natural resource firms, the use of all three, therefore, is often associated with the acquisition, exploration, and development of new oil and gas reserves. Accrual accounting permits companies to recognize capital expenses in periods that reflect the use of the related capital asset. In other words, it lets firms match expenses to the revenues they help produce. For example, if a large piece of machinery on property requires a large cash outlay, it can be expensed over its useful life rather than in the individual period during which the cash outlay occurred. This accounting technique is designed to provide a more accurate depiction of profitability in the business. We will be ending on this note. In the next module, we'll be learning about revenue recognition in oil and gas.